All right, guys, let's jump right into the video. We're going to talk about the four most popular futures trading strategies, and these are used by individuals who I've seen actually obtain a payout, and I use a lot of these to actually obtain my first payout. Most people use support and resistance. A support level is any level where the market basically turns or a pivot point, or it could also be a collection of points in which the market bounces from. For example, the market came down here, this level, and bounced several times. So if you look here, there's about 3 or 4 touches. You can say this is support. So the market came down, bounced up, bounced back to support, came back up. If it bounces from the top, that is resistance. Very, very basic stuff. Some people use support and resistance as a means to trade. They'll wait for the support to be broken. For example, this is your support level back here. Price is coming back down to this area. It seems to bounce every single time. But notice here, and this is a 5-minute chart on NQ. But notice here, the moment price closes below, the body of the candle closes below support, notice how you get this huge drop. So a lot of people will use that particular strategy. Now, when does this fail? Most of the time, if you're trading support and resistance, and you'll see a better picture of this on the 1-minute chart, if this is going to be a fake out, what you want to watch out and avoid is, let me see if I could find one. Here's a perfect example right here. Let's say that price came up here. Well, let's say that you had let's say this is your resistance line right here. And this is when this strategy fails, and I'll explain to you how to kind of weed out. I'll go over it again, even though I kind of touched on it here. So this is your resistance line here. Price came, it closed above. And you may look at this and say, well, it's going higher because this is resistance and it broke resistance. Now, there is a telltale sign here, which is this wick. Price attempted to go up and was pushed down. But there are times when there's a wick and price continues to go higher, but this didn't. This actually came down and closed back below the resistance line, and then it chopped around, and then it went lower. So anytime you see resistance broken, it may be beneficial for you to wait for another candle to actually close above. So for example, like we said back here, price broke above what was resistance. This candle, the body of the candle, closed above, and you can go higher. Now, another thing on the chart, which actually falls under the category of support and resistance, is the VWAP, or the volume weighted average price. I believe that's what it stands for. This is TradingView on a 1-minute chart, but if I was to go to indicator, this is exactly how it looks right here. Chart VWAP by TradingView. So you double click that, add it to your chart. The main line I'm talking about, it'll show you a lot of different levels and lines on here. But what you want to do is come here and just make sure that the chart VWAP is the one that's selected. Anything else, you can unselect these or just change the color and ignore them if you wanted to. But the chart VWAP, a lot of people will look at this and trade this based upon support and resistance. So for example, but let's say you were looking to sell when the market came down here, right? You're looking to sell and you saw this candle and you said, well, I want to wait for a pullback. And you waited for a pullback and you was about to get in to go lower. Where if the chart VWAP or VWAP, whatever you want to call it, is up here, this tells you that price may pull all the way back to this level before it goes lower. Because a lot of traders actually look for price to pull back to this level and reject this level, which is what it did here. Reject it, did not close above, and then it actually came back down here below this level. So a lot of people look for a pullback to this level. And when it gets to this level, they want to see a rejection or a break. Again, I will, and again, this falls under the support and resistance category, which means just because price closes above this area right here, or this VWAP, it doesn't mean that it's going to continue to go higher. So one of the things you want to pay attention to here is, yes, you can pay attention to make sure the very next candle closes above, but as you can see here, that would not have been a successful trade. It broke, closed above, this body closed above, even though it's a red candle. But notice how it did not close above this resistance line right here. All right, so it still did not break out of this range. So if you're trading support and resistance, you need to make sure you look at all of the different aspects of support and resistance. So yes, you want to see a break and close, but you also want to make sure you're looking at the bigger picture. All right, so the next thing we want to take a look at here is what people refer to as initial balance, or the first hour of the trading day. And you can usually look at this on a 5-minute chart. It really doesn't matter. But this is going to be from market open, which for me is 8:30 Central Standard Time to 9:30. So you got the 8:30 here, and then you have the 9:30 candle here. So what you want to look at here is let me get this off the chart here. Let me clear this chart, remove the drawings. So what you want to do here is you want to come here 8:30 to 9:30, and you want to mark the low between that time frame. So in the highest the market went within the 8:30 to 9:30 time frame, and again, this is Central Standard Time, is here. So what a lot of people will do is they will wait for a break above this level or below this level before they make a trade. If it breaks above this level, they're looking for longs or buys. If it closes below this level, they're looking for sales, or they're looking to short the market. Now, again, this is another support and resistance strategy. Basically, it all kind of follows under that support and resistance uh, caption, but it does work. And you do have to, again, you have to be careful here, because even though it broke, again, it broke above here. This candle closed above, but as you notice, it rolled back in to the support, under the resistance. All right. So, and that was the end of the market. And no strategy is 100% accurate. So, what you want to do is you want to make sure that you have a proper risk to reward ratio. That way, when the trade don't work out, so for example, if the trade would not have worked out, it closed slightly above. Go back over here. It closed. Let's just say it closed slightly above the initial balance high. That's what they call it, the initial balance high. Then you know that you can have a very tight stop loss, because if you're looking for that to go higher, you just move your stop right up under that initial balance level. You don't have to risk that much. Maybe you can risk $100. So if you lose on that particular trade, you've only lost $100. Okay, and I hope that makes sense to you guys. If not, just put it in the comments. But when you win, you will notice that you will win. The market will shoot very, very high, and you can have the potential for large wins. All right. So here on this particular day, let's just say that other day which I believe was today, was a loss. But let's go back and see what would have happened on the day before. All right. So this is 8:30, and let's say the low. We'll mark the low. It's kind of off there, but we'll mark the low there, and then 9:30. Where's 9:30? This candle right here will mark the high. And again, we're looking for a close above this level. So notice how this candle closed above, this next candle closed above. And yes, this is support and resistance. So a lot of people look for the break and then the retest. But even if you was to get in here, you would know that you're looking for this to go higher and not rotate back into this level or break back into this zone or level, right? So your stop could be very close to this resistance level here. So let me make this bigger so you can see. All right. It broke above here. And what did it do? Went higher. All right. So if you're looking at this, let's just say you got in here and you did not wait for a pullback. Then you would have been at, what is this, 421. And you can see it went all the way up here to, that's a lot. 507, and I'm looking at the last three digits, so 2507. So that's a lot of points that this went up. Of course, I mean, who knows where you would have gotten out at? I mean, this could be a good reference over here to get out at this high over here. Um, and that would have been, you know, 50 points or so, 50 or 60 points if you would have just held to this level, I believe. Great. That would have been a great trade. And then on the other trade, like let's say today, if we were only trading this strategy, let's say today we would only lost maybe, I don't know, 10 or 20 points, maybe. And then over here, you would have gained, 50 or 60 points. Let's talk about the other strategy. You'll probably recognize this strategy. I know a lot of you probably use this strategy. So we'll talk about it and talk about when the strategy fails and what to do. A lot of people use the trend line strategy. So they'll draw a line here. You see touches here, and they'll wait for price to break, wait for it to pull back a little bit, and then try to take the market lower. All right. The problem with this strategy is a lot of times they will fake you out. Like this is great right here. So let's say you were looking at for this trend to be broken. And a lot of times this is what you'll see when people are trading the strategy. They'll draw a smaller trend line and then they will draw a bigger trend line. And they'll say, okay, if this breaks the first smaller trend line, it is going to head to the bigger trend line. And this plays out a lot of different times, and it's a very simple strategy. The only problem with this strategy is that new trend lines are created when new candles are created. So this is a good example because you have a trend line here, and you have a trend line that you have a candle wick here, and you have another candle wick here that sticks out. So you can kind of keep that point of reference. But let's say that you don't have this point down here, and you only have, let me take this off the chart really quick. Let's say that you only have this level here and these trend lines here. So let's say the market is right here. This red candle don't exist. Well, normally what you would do, you would come here and say, okay, I want to draw a trend line. You draw your trend line here, and then you wait for a close below. So right here, it closed below. But when it closed below, it went back up to this trend line. Well, that means you'd have to draw another trend line, which is here. So now your trend line moved from here to here. And now, of course, you have more touches, and then you wait for the break, and then it goes down. But what if this candle stopped here and went up higher? Well, then you would have to adjust your trend line again. The problem with that is if you got in and traded every time it broke those smaller trend lines and created a new trend line, then you would probably be at a loss. Okay. So that's the problem with this strategy. But here's how you can potentially get around that. What you want to see is you want to see price pull away from the trend line and come back to the trend line. So you want to see this. Price pulls away from the trend line, comes back to the trend line. And then when it closes below, so for example, if we were right here, when it closes below, and then the whole body of the candle closes below, you want to see the support level broken before you get in. Okay. So this is support. You know, you can't really see. I got some things here. Let's take this off. Let's hide the VWAP here. All right. So you have this trend line here based upon this wick and this wick. That's all you have. None of this exists. Price comes down. It closes slightly below that trend line. This candle wicks up, wicks down, then closes. You think because it closes below, it's going to go lower. But if you were to look at this area right here, look at where the body of these wicks stopped and wicked out, you want to see price close below that level before you go lower as a means of confirmation. Now, if it's a very long trend line, you can chance it. Like, for example, it pulled away from the trend line here, came all the way down here, and now you have price wick below. You have these large candles falling here. It's wick below. And then this candle close. This is a huge, another huge down candle here. you can wait for a close, and you can basically risk it. You can say, okay, well, this may go down, this may not go down, but I know that I want to get in, let's say here, and I know that that if it comes back up to this level past this trend, I want to get out here. All right. So you can do that. You can say, okay, I want to risk this amount to make this amount. All right. So you can do that. But notice what it did. It broke here, it came back up a little bit, and then it did come down here eventually, but it went right back up. And what else did it do? It formed another trend line, or a different trend line, I should say. But look, this is a situation where it closed below here. Well, this one candle went all the way down. So that is a problem with the trend line strategy. But like I said, if you mix that strategy in with support and resistance, and maybe the VWAP as a solid strategy or an addition to your strategy, it may or may not be beneficial for you. All right, so let's talk about the very last one here. Now, the very last one is more of a concept or a methodology or a trading framework that a lot of people use, and that is the ICT inner Circle Trader. He has a YouTube channel, and he teaches a strategy that is focused mainly on what is referred to as fair value gaps. So what you'll notice here is, let's find one. So when price comes down or goes up too fast, it forms a gap. And by gap, we're looking at this candle, and this candle. These three candles. Notice how the body of this candle, this red candle here, if you look to the left or the right, there is no overlapping wicks or bodies. And I mean immediately. Way back here, yes. Way up here, let's just pretend this don't exist. And what you'll see a lot of people do is they will draw a box on their chart that looks like this. From this wick, from this candle, from this wick, from this candle. So it looks like this. All right. So you'll see this box. In the box, again, from this wick on this candle, and it ends to this wick on this candle because it's going down. This is a bearish fair value gap. Now, what they will do, they will wait for price to come back to this area, and they would trade this to go lower. All right. Or if it breaks this area up here, they would trade it to go higher, usually to some, what they refer to, level of liquidity, which is a wick or a pivot point or a high, whatever you want to call it. And that's their strategy. And their stop would be, if they're going, if they're placing a buy or bullish trade, their stop loss would be below this fair value gap. The problem with this is exactly what you see on the chart. Bearish fair value gap, it comes back to this area. You expect it to go lower, but it pushes back up through this fair value gaps and break it and goes higher. So the problem with this is a lot of times your risk to reward is very large. You can have a good risk to reward, but it's large. It's a large amount. So for example, you're not risking 10 points to make 30 points. A lot of time you're risking 30 points to make 90 points. So that's why you're here a lot of the traders that trade this ICT concept, which they refer to as smart money concepts or SMC. You will hear them say, oh, I made 100 points today, which is great, but that's just not my trading style. I don't want to hold and lose 30 or 40 points for the potential to gain 120 points or over 100 points. That's not my trading style. I would just rather risk the 10 points to make 30 points or 40 points and be done with it and move my stop accordingly. All right. So hope you enjoyed the video. Those are the strategies that you will see a lot of different traders use. So if you just go to YouTube and type in live futures trading, you will see a lot of people trading those particular strategies. And that is what the methods that I've seen traded from these individuals. And there's a few others, and you can kind of watch it and see if they work. But these are the most popular ones that stand out, in my opinion. And this is kind of what I look out for because I know other people are trading it and it's traded by a large range of people. So if you're new to trading futures, hope that helped you guys out, and make sure you guys subscribe to the channel because I have other videos and tips for you to hopefully help you succeed in your trading journey. All right, thanks.